let's look at the dollar for a second, because part of the diversification strategy, whether it be into gold or whether it be in Bitcoin, I mean, we got a country down in Latin America, right, that actually chose to hold its sovereign wealth, whatever it had, in actual Bitcoin. And it's been tough, right, because it's hugely, hugely volatile. I would caution everybody with that. But I'm looking at the dollar right now, and it looks like, okay, so it's going down a little bit. Is this right? This is US dollar index, and we're looking at the dollar relative to peers. You know, the ECB, they came out, they jumped the gun. They cut before Powell. I wonder if he felt like he had to do 50 bips because, you know, Europe's hot in the trail.
Yeah, I think he definitely did mention that. You know, it's kind of referring to what other governments are doing to justify the stronger move. But
So,
what we see
just
here,
to back
I mean,
up, and the reason you want to have at this point a weaker currency, the reason they're trying to do that is because they want to be able to encourage this commerce sort of overseas, if you would, right? You want American companies being able to sell at competitive prices abroad.
Yes, that's part of it. But you could also see how that now becomes inflationary because,
Sure.
I mean, this is why, you know, you raise interest rates and that leads to dollar strength. But then as they get cut, you know, it's dollar weakness. So now we have to pay more for imports because we you know, our purchasing power overseas is lower, and then we'll stimulate exports, and that will kind of, in theory, create jobs. But it's definitely, you know, that's one of the mechanisms through which interest rates affect inflation, and it's doing what it's doing what it's supposed to do, and now we're looking at a weaker dollar relative to other major currencies and relative to gold and relative to Bitcoin.
Which should be a little bit sort of a, you know, a helping hand, if you would, to earnings, et cetera. So you know, look, it's very easy to be negative on the government, and certainly I've been extremely critical of the Fed and obviously this administration and their economic policy, which to me is completely, totally, utterly lacking. But that said, you know, I'm okay with, I mean, I love King Dollar, but sometimes, you know, doing what we're doing sort of on the margin, I think probably helps the overall environment for corporate earnings. I mean, the flip side of that is you never want to be devaluing the dollar, because guess who pays the price? Americans here at home, which gets you back to, dare I say, why you need to be investing, right? Whether it be, as we've talked about, in gold as a way of, you know, hedging your inflation, whether it be in equities. I think you have to be really selective in a time like this. I'd still be looking to, you know, look at my inflation protection portfolio and the basic income portfolio, and then also this resilience, American resilience, because this is a real story in terms of tech opportunity right now. I think you have to consider that, knowing that the Fed is always going to tinker, and that you're always at risk of a bunch of morons in Washington, D.C., you know, not really getting it.
Yeah, no, I mean, you know, when we look back at this whole cycle from COVID to today and the inflation, look, everything that was done ended up, you know, to the benefit of asset owners. Stocks had a rocky ride with the uncertainties around COVID, but you had tremendous buying. We were talking about it earlier.
Huge.
Amazing.
I mean,
buying opportunity.
I was looking at my portfolio the other day, and I went back and I looked at. I mean, I did a lot of buying around that time. It really infuriated me. It sort of came out on air my last night on Fox. Because I was like, you got to be kidding me. You people are like driving the market down 2,000. I mean, this is insane. This is insane that we have ratcheted up the hysteria. Now, you know, looking back, I mean, people did get really hysterical, and, you know, the whole country was shutting down, and I get it. And, you know, we don't want to ever relive that. It's quite possible we will. But I think having gone through that, having gone through what we went through in 2008, having gone through what we went through in 2000, I think the moral of the story is don't bet against the USA. And as freaked out as the media gets, and as freaked out as Wall Street gets, the answer is, you know, have your own compass and know what the end game is. I mean, if you got to get out of the market in a year, that, you know, that's maybe a different story. But I looked at that back in 2020 and in March, and I'm like, okay, so, you know, I'm buying. I'm buying when everyone else is selling. And it turned out to be a very smart move in retrospect.
Yeah, it was. And I mean, in those periods of dislocation, you get panic selling and you get kind of these technical factors that just kind of, it's like sort of like, what are the Black Friday on Thanksgiving, it's like just
Mhm.
these flash sales, to buy good companies, on deep discount. Um, but yeah, I think, it's don't bet against the USA, but it's also like don't bet against the Fed and don't bet against the way the system promotes growth in.
Even if we get annoyed with the system, even if we get annoyed with the Fed, it's like, okay, we're realists here because you want to make money.
Yeah, it's like don't hate the player, hate the game, right? I mean,
Yeah.
we're in this system. There's nothing we can, it's a pretty good system, and you want to thrive within the system. And I think the system is very much geared towards people who put their money into risk assets, and they're rewarded over time.
So with that in mind, I just want to once again shout out, we're going into a weekend, so it's a great time for people to focus on this stuff. I know I focus a lot on the weekends on my personal finance. Rob and I are always talking about opportunities in markets. We're always talking through our portfolios and making sure, we're not here to get you in and out of things. If we add something to the list, it's because we really are big believers long term in what those opportunities are. So this is not like, we're going to run in and out of companies, but it is a good time. I encourage people to spend some time over the weekend here and go to our website. There's a lot of stuff for free. Just sign up for 76 Research. Try to get the 76 report if you can swing it. It's $1 a month. And guess what? You know what? You can cancel for free anytime. So it goes to $9.95 after the first 2 months, but you can cancel anytime. So I like to remind people of that because no harm, no foul, right? Go try it out. And there's a lot of ideas there for you and a lot of explanation and a lot of great reading for you to do. And then, if you are really ready to go, we have 3 different portfolios that have performed very strongly. I was just showing you the basic income builder portfolio. So take a look at those as well. 10 to 15 stocks in each one of those names. You can sign up for the Founders Club and get everything, including the 76 report at the best discount. So that's the best deal.